Ben, what do you make of all the inversions happening at the same time that we've seen bond yields go higher on the expectations of higher interest rates? Is all of this a threat for the stock market rally?
Hey, Sarah. I don't think it is because, we're at this cycle where the Fed has just lifted off. And I think the market is really trying to price what's the appropriate Fed funds rate to get this inflation rate ultimately down back to target over time. And that's what you're seeing with Treasury yields. They're all moved up since the Fed meeting on mid-March, all moved up about the same, a little bit, 2 year, a little bit more. So you get this inversion, but you mostly get actually yields that are above what the Fed considers to be a neutral rate, around 2.5%. So I think the market is working towards this process of saying this Fed funds rate may be somewhere in 2.75%, 3% range. That may be sufficient then to bring inflation down. I think that's what the story of Treasuries is, which had no negative bearing on the equity market.
So if that's the case, so we're looking at March performance coming up at the end of the month this week. Every sector in the S&P is actually higher for the month of March, obviously led by energy, which is up 9%. But the weakest sector is staples, up 0.6%. What is the strategy for April? Do you see more of the same until this conflict with Ukraine gets resolved, or do you switch it up?
I think that the strategy remains similar. Let's say that, we have this big wave of inflation coming at us. It's a lot of food inflation. So that sector is obviously doing extremely well. I think that's going to continue to perform. You see the switch between growth and value. That sounds a bit broad, but that is really a reflection, I think, of future expectations that ultimately inflation will come off. And this is, I think, why the growth trade is revived. There's also emerging markets that are on an uplift here, despite that the dollar is breaking towards this 100 on the dollar index. And I think broadly that the market remains in this, I say, positive tone. If there is ceasefire, that's a tail risk off the table. If inflation does get adequately attacked by the Fed, that will be eventually a tail risk off the table too. So I think that's why you're seeing the positive momentum going into April.
Is it too early to bet on inflation coming down by buying tech?
Now, I think it is actually a timing more about over time that inflation comes down. We can't expect inflation to go from 7-8% or so this year all the way down to 2 within a matter of months. If that happens, then the yield curve reversion is right. It will be signaling a recession. So since we're not in a recession scenario, I think it would be more about inflation seeing moderating more by the latter half of next year, really down to 2%. So yet tech was so oversold that I think that has a lot to do with it, that of the momentum, positive momentum coming back to people seeking it out for that reason. Ultimately, high growth companies should prevail when inflation does start to moderate. So that, I think, is what the market rationalizes here. Quite right, I think.